Good afternoon, ladies and gentlemen. This is Charles Sells, CEO of the PIP Group. This is an introductory presentation on who the PIP Group is, our history, what we have to offer from tax liens to current turnkey fix and flips. This is by far the longest presentation in our series of online webinars. The beauty of having it online and pre-recorded is you can fast forward through anything you're not interested in and just get to the meat of what you are interested in. So let's go ahead and get started. Okay, so first, a little bit about me. I began my career investing in distressed real estate at the age of 23. I literally started by stuffing envelopes in the office of somebody who was a service provider and coach in the industry. And then by 26, I branched off on my own with about $4,000. I formed a company. I took a few investors along with me, and it eventually became what is known today as the PIP Group. PIP Group provides a wide range of services to both individual and institutional investors. They're both foreign and domestic. We have funds out of Norway and Germany and England and all over the world. We provide services to investors ranging in anywhere from size of $50,000 to we do some auditing work for a few hedge funds out there that have values as much as $150 million. Now, obviously on those hedge funds, all we're doing is auditing, no management type work. So we're really just going in and making sure that they've dotted all their I's and crossed all their T's. With close to 20 years in business and about almost 1,000 clients served to date, we are an industry leader and a well-known provider to investors worldwide for the services we offer in distressed real estate. Now, before we get too deep into this presentation, I would like to share a short story. About 4 years ago, my wife and I were in a nasty boating accident. So nasty, we actually ended up making the front page of our local paper here. And ever since then, I've not taken life as quite as seriously as I used to, and that's actually been a huge benefit to both us, our businesses, and even our marriage and our family life. But needless to say, because I don't take myself too seriously anymore, that does tend to play out in my presentations from time to time. So I like to try to keep them entertaining and okay, so again, the PIP Group does not offer any coaching. We do not offer any bus tours. We do not do platform sales and do a bait and switch program to bring you into a weekend workshop, tell you that we're going to offer you one thing and then try to sell you something else. We are not an investment fund or a pooled investment. That means the investments are yours. So it is your investment. It is recorded in your name. We are a service provider offering our expertise and our services and our resources to make you successful investing in distressed real estate. Being said, on behalf of the PIP Group clients, we provide double-digit returns in investing in distressed real estate. It's high yield, it's collateralized by property, and we consider it conservative. It's real, it's passive, and it is turnkey solutions for our investors. We make complex investments simple from anywhere in the world. So contrary to popular belief, investing in distressed real estate is not a get-rich-quick plan. It does require hard work. You can be successful. Slow and steady does win the race when you're investing in distressed real estate, whether it be tax liens or you're doing some of the higher end fix and flips. It does require a lot of effort and a lot of work. It is not the late night infomercial that you caught after you've had a few too many drinks on a Thursday night. With that being said, when I got started in this business back in '98, I worked a lot of odd end jobs. I was one of the best sign spinners you'd ever see, and even a stint with Ronald McDonald, and I did that for a lot of years before I finally started turning profits. So I worked literally 2 and 3 jobs at a time until we made this business successful, and we have been growing it and growing it and growing it, slow and steady. So again, slow and steady wins the race. You're not going to get rich quick, but you can make very good profits and eventually make an entrepreneurial career out of this, if you will. All right, so let's talk market trends for a minute. Of those of you out there that believe that the housing market is about to pop another bubble. Now, when I have this presentation live, about 50% of the room will raise their hands and say yes, and the other 50 will say no. It really depends on where you get your data and how much you believe in, our mainstream media resources. Now, if we look at one extreme market, and everyone's probably heard of this market out there, this is what's going on in San Francisco right now, and it is just absolutely crazy. Look at where the bubble was when it popped back in 2006 and 2007, and look where they are now. They're almost double what they were. Well, they're 30% higher than they were in 2006, 2007 when the bubble passed. So we are definitely on the increase of look at a little more data. The U.S. median home price appreciation decelerated in 2018 to the slowest pace in 2 years. As I'm recording this webinar, it's January 9th of 2019, and you can see all the hot spots here. They're the notorious hot spots from the last housing crash, with the exception of what's going on in Arizona right now. But you can see, Southern California and pretty much all the state of Florida are the biggest hotspots as they were back then as well. 1 in 10 U.S. properties is seriously underwater on their mortgages right now. When the housing crashed, I believe it was 3 in 10. But again, look at those hot spots. We're headed. The writing is on the wall. We're seeing some things happen, and yes, I do believe we are headed for another mini market shift. It's not going to be as dramatic as the last one. Something. Foreclosures started their increase again in 44% of the U.S. markets back in July. And again, you see those hotspots. They're all where they were last time. So we are seeing it again. Home flipping rates increased to a 21-year high in 2018. That should actually say a 12-year high, with more than 200,000 homes flipped for the third straight year. And look at where those flips are going on. So what do you guys think? Is now the time to buy distressed property in the U.S.? Well, absolutely it is. I like to say any time is a good time to buy distressed property in the U.S. We were a very young company when the dot-com bomb hit, and we did very well. The housing market was very strong at that point, and we still did very well in distressed real estate. When the housing crashed, we still did very well. We just had more inventory to work with. Now, it is pretty much what we consider an all-cash business. So those with the cash get the deals. So we had more inventory. We had to sit on them a little bit longer, but not too much. It really didn't impact us as far as getting new buyers in there because we do what is called recession-proof investing, and we'll cover that a little later in this presentation. But needless to say, anytime is a good time to be investing in distressed real estate, but heck yeah, it is. It's definitely a really good time right now to get your feet firmly planted as we come into a market shift and a market change, as long as you're buying right. And we're going to discuss buying right as well a little bit later in this presentation and show you some examples of what we're. So again, contrary to popular belief that you catch on those late night infomercials, investing in distressed real estate is not sexy. It can get real messy at times. These are samples of our current properties, and this is essentially what they look like when we get into them. There's a lot of different scenarios as to why a property is foreclosed on, or they're not paying their taxes, or what the case may be. They obviously don't go very happy. And they tend to leave a big mess. So if you're investing in distressed real estate, this is what you're going to do. But what we're mostly interested in is being profitable, not sexy. So again, contrary to those late night infomercials, it is not a little known opportunity other investors don't want you to know about. It does require hard work. It can pay big profits. And if you're willing to put in the time and effort, you can do really well investing in distressed real estate. Or you can just hire us to do it for you. That way you have a win-win, and we'll discuss that again as well. But we are a performance-driven company, so everything we do, the commissions we make, the fees we make, it's all based on the performance of your investment, which again is recorded in your name. Okay, so you can hear me say a lot of the times, whether it's live, it's recorded, um, if you're at another event with a legitimate speaker, they're always going to make the statement of, did you buy right? It's not, you know, are you doing the rehab right? It's, did you buy right? Because if you didn't buy right, you're already behind the eight ball. Uh, we're going to look at a lot of different things that we offer and a lot of different um, profit scenarios that you know, our real life clients have earned. But this particular one actually is one that my wife and I own here on our little island in Hilton Head that we acquired in August of 2018. And we're just going to look if we bought right, because if you look at these pictures, it looks pretty scary. So we'll go through and see this at the very end of what the final outcome of this particular property was. All right, tax distressed real estate. This is where we started our business, and this is how I got into my career, was investing in tax liens in various states and helping my boss manage those liens on behalf of his clients and whatnot. So this is going to be the most uh, long part of this presentation. So if you're not interested in tax distressed real estate and you only want to know about fix and flips, just fast forward, because this is going to take a little while. It's pretty in depth, and we'll get through it. But again, if you're not interested in tax distressed real estate, just fast forward on through. So what are tax liens? This just seems like a very simple question, right? It's a reliable and predictable source of revenue for local government. Well, I have a client that he's been with us for about 3 years now, and he was in town a few months ago, and he has a fund that's about $5 million fund with us. And he said, you know what, Charles, I didn't even know what tax liens were until 6 years ago. And we just decided to start this fund and started doing it on our own. And then we obviously, through the industry, ran across you guys. So, you know, very smart people and very successful lifestyles don't know that this is actually an investment opportunity. So what happens is local government, your county level government, collects real estate taxes from all property owners for all properties. Those taxes pay the budgets for schools and firefighters and police. All of those county related facilities are all paid and funded by property taxes. So they cannot have a shortfall. And to resolve that issue, because people pay their bills late, the county then sells those delinquent taxes to investors, usually at an auction. Sometimes they'll do it closed doors, but most states, it really depends on each state. And a tax lien is created. So from that, the delinquent owner has a set time, and that's determined by the state law, to repay the debt plus all interest and penalties, or forfeit the rights to the redemption of the property. Now, to give you some quick examples, in the state of Illinois, which we're going to get a little more into details on, it can be as much as 36%. My state of South Carolina, it's 3% per quarter. Georgia, it is 20% if it's redeemed the next day or within a year. So every state's different. We're going to focus this presentation specifically on Illinois because it is one of the more popular ones for our investors. So the taxing process, if you will, from delinquency to foreclosure, if the property is not, if the lien is not redeemed, is pretty simple. The taxes become delinquent, they're advertised for sale, and they go to public auction. There's a period set by the state for redemption and what we call maturation of the lien, and then you foreclose or do the foreclosure and quiet title action. Now, there's different states that we call judicial foreclosures and other states that don't require judicial foreclosure. Since we're talking about the state of Illinois right now, we're going to talk about judicial foreclosures. And at this point of the presentation, I will say that we do have a much more in-depth presentation that is specifically about investing in Illinois tax liens that covers a lot more of the details. So if you are interested in something like that, I would recommend you go watch that presentation as well. Okay, so once a person has learned about this great opportunity of investing in tax liens, the first question that I'll get asked on the phone or uh, in a presentation is, what about the first mortgages? I'm buying this lien, but what about those first mortgages? Well, property tax liens actually supersede a first mortgage. They are what is considered a super lien. Examples of super liens are IRS liens, property tax liens, code enforcement liens, and condo and HOA liens. Now, I've listed these roughly in the category that they would fall of importance, if you will. So, IRS liens, what happens if there's an IRS lien on the property? By law, we have to give them 180 days to determine if they want the property or are going to cancel out our lien. They essentially become a redemption individual as well, and they pay off the lien and they take over the property. That's actually never happened. In the hundred thousands of liens that we've bought and redeemed and foreclosed on, we've never had the IRS actually do that. Usually they're after the person, not the property, not the investor. So we give that 60-day, excuse me, that 6-month notice, and then we move on. Now, code enforcement liens and condo HOA liens, those will continue to ride with the property as we go through foreclosure. So if there's code enforcement, and an example of code enforcement would be, the grass has been neglected and has overgrown, and the city has gone out there and they've cut the grass. That's a code enforcement lien of $40-50. So we'll pay those off when we get to that stage of the foreclosure process. Condo and HOA liens, depending on the association, they can be very easy to work with or very difficult to work with. But again, it's going to be insignificant to what your overall profits are going to be once we either sell the property or you cash flow the property, whatever you happen to do with it, if it doesn't redeem and you foreclose on the property. All right, so Illinois tax liens. And so the PIP Group was essentially built on the foundation of the popularity and our keen ability to bid in the state of Illinois very well on tax liens. Our bid rate average, our purchase rate average, if you will, is 24% or better per year. And that's going on probably close to 15 years now. In the state of Illinois, the way the process works is if you have $1,000 tax lien and they offer it at the auction for 18% bid, you bid down on that penalty. So 18% would be the max. You could go as low as zero if you just want to park your money for no profits at all. But what makes Illinois so cool is that whatever rate we bid at, if it's 18%, that amount doubles every 6 months. So if we bought it at 18, after 6 months and a day, it becomes 36%. After 12 months and a day, it becomes 54%, and so on. Another cool thing about Illinois is not only is it doubling, but it's also a penalty state. Penalty basically means that the interest rate is not prorated like other states are. So if we bought $1,000 lien and we bought it for 18% at 1 o'clock on a Tuesday, and the homeowner came in to pay off that lien at 4 o'clock on that same Tuesday, they would owe $180 on top of that $1,000. So it's penalty. It's not prorated. So your annualized can actually look a lot more attractive, or if they get redeemed too quickly, not as attractive. We like to see liens go at least 6 months in a day because that's when the interest rates obviously get really interesting, and the redemption is when they come in, looks really cool. All right, so this is what a tax sale certificate looks like. Every state's different. Some of them just give you receipts. In the state of Illinois, they all look different. Some use this service, which, this certificate comes out. One year they're blue, one year they're yellow, one year they're green. Some other counties, they'll be in portrait format versus landscape. But essentially, they all carry the same information: the year of the taxes that were sold, a certificate number that's been assigned to it, the county, the date of the sale, the parcel number of the property, the tax code. In this particular one, you can actually see exactly what it is. It's a cell tower on leased land, and we bought it for $4,038.23, and it had a penalty rate of 18% when we bought it. Now, a lot of people out there will go, why in the world would you buy a cell tower on leased land? Do you know how expensive cell towers are? and how in demand cell towers are, and with keeping it green these days, it's a ton of value. This one redeemed out very quickly, so that is definitely something we buy all day, and other traditional buyers might not be interested in it, which is why we got it for the max penalty rate. All right, this is just a redemption report that shows uh, that compounding effect I spoke to you about earlier. It shows how much we bought the lien for. It shows that it's actually being redeemed for more in penalties than the actual original lien cost, which means it redeemed out for 100%, 108% in approximately 3 years. So you can see the date of purchase, you can see the date of the redemption, the county redemption report that is sent to us, and then essentially what we do is once we get this report, we send the report back. We send the certificate back to the county. They then send us a check in your name or your self-directed IRA custodian's name, and that's that. That lien has been redeemed. You've made your profits. It's back in your account, and we move on to next. All right, so that covers tax liens. Now we're going to talk about secondary market tax liens. This is an industry that essentially self-evolved shortly before the global financial crisis of 08 through, call it 12, and it's actually created a great new investment opportunity for those investors who do want to acquire property. I won't say pennies on the dollar, I hate that term, but I will say for a significant discount. Again, the process is pretty simple. It's just a matter of where you're buying or you're investing versus the tax liens. Rather than buying the tax liens when they're advertised for sale at public auction, you're buying them between the redemption and maturation time and the time that it's actually ready to be foreclosed on. So you're essentially just shortening that window by whatever the redemption period is. And this is a huge market. These are not just what some in the industry call over-the-counter liens or the trash that's out there. There are some really good opportunities out there for this. I will show you some extremes, but more or less, the secondary market is one of my more it's my second favorite investment opportunity that we have to offer. So essentially, what happens is a lot can happen in distressed real estate between the time you buy a lien and the time you get to foreclose. So on everything we buy, we do a reassessment of the collateral property. Make sure it is what we bought when we bought that lien. We notify the owners and the occupants and give them terms and negotiations. Maybe it's a renter and they want to stay in the property. We'll negotiate for them to stay in the property. Maybe even put them under a contract for deed and sell them the property. So it's already cash flowing when you actually start doing the secondary market acquisition. So then you engage in secondary market, you make your investment, and then we start the foreclosure and the prove-up process for you. Another notification is sent out to the homeowners and the occupants. This is what we're doing through the legal process. Foreclosure and prove up can take up to 9 months. We're still notifying owners and occupants, and then we're having hearings and doing these prove ups. So I told you in the state of Illinois, it is a judicial process. So we're taking our attorneys to the court, and then in order for the deed is granted by the judge, we pay back taxes and municipal liens, and you're off to the races. Like I said, there are extreme examples of secondary market acquisitions and sales. This is one of them. This is probably a record breaker for us, but this is one that was acquired, sold on behalf of one investor in tax liens and acquired by another investor in secondary market. They bought this for $13,309.90 and they sold it for $65,000. Now that's the extreme. This is the standard. So the investment in this particular condo, which as you can see by the notes, is occupied in a great community. Owner claimed he would pay the taxes, but he didn't. So he invested $13,037.35. Now I will say, this is introductory to what we offer. We have another presentation that is specifically on secondary market and pre-deeds. It's pretty complex. little convoluted just because of the way the laws in the state work. So again, if this is an interest to you, secondary market, which it should be, as you can see based on some of these numbers you see on the screen, go watch that webinar for sure. It's also a seasonal opportunity. Secondary market comes up February, March, April, and then that window closes until the following year. So you saw on the previous screen while I was talking, PIP Group's evaluation of about $26,000 on that property. On everything we do, every lien we acquire, we take what is of record. In other words, if we buy a bunch of tax liens for you, you go and you want to check out the valuations that we provided, you're going to find a valuation on record that's going to be higher than what we show, because we're depreciating every single one because it is distressed and we don't know what's going to happen. So in this particular one, we say it was worth $26,000. It's sold in 2016 for $35,000, and you see you've got different valuations here of $57,000, $56,000. We know in this example it's going to be somewhere between our valuation and $55,000. So again, assume that it's going to be $35,000 for this particular property. Your cost on it, all in, is going to be $13,037.35. So you can see why I really like secondary market tax liens. All right, pre-deed acquisitions. Now we've covered secondary market. Now we're going to talk about pre-deed. Is you understand secondary market and you understand tax liens. All we're doing is we're kicking that can down the road a little bit further. Rather than initiating foreclosure, foreclosure is done. All you're having to do is pay the taxes and the property is yours. Now again, in both the presentations for secondary market and for pre-deed, we discuss in more detail where these properties come from and why they're available. And essentially, the quick answer is that there are people whose models are to invest strictly in tax liens, and they can't afford the liability of REO, of owning properties in real estate. That hurts their buying power in tax liens. So it's created these two markets of secondary and pre-deed. We just started offering pre-deed in 2018, and it's been far better than we ever even expected it could be. So essentially, tax liens now, secondary market now, and pre-deed is all we've done is we just kicked that can a little further. More opportunity for you there. If you're interested in pre-deed, go watch the webinar that is specifically on pre-deed. So something you're always going to get with the PIP Group is transparency. That's something that's hard to come by in our industry, especially for service providers. So we try to stand out and provide transparency as much as possible. Here's an example of a pre-deed for you. This one's already off the market and it's been acquired, but you see I've given you the address there, so you can actually go through and run your own numbers on it. And again, it's not sexy. This isn't a beachfront condo. Yes, we do get those from time to time, but 95% of what we do is this. It's stuff that's going to be easy to sell, easy to cash flow, and the margins are going to be huge. And that's essentially the business that we're in. So here's a sample of a pre-deed in the presentations online specifically to pre-deeds. You can see more examples as well as go on our website and you can actually select certain pre-deeds that you may want to buy. All right, now the fun stuff, the ever so popular fix and flip. Everybody wants to be in the fix and flip business these days, don't they? Well, so many people, in fact, 9,300 Americans attempted their first fix and flip in 2018. Can't exactly remember where I got the data from, but it's probably Atom data. That's where we usually get it. That number was actually a lot smaller than I expected it to be, but what I found interesting is what percentage of those 9,300 actually made a profit. I'll give you 2 seconds to come up with your own number. The number was actually higher than I expected it to be, but that number was 13%. By higher, I mean I expected it to be closer to like 5%. So 13% made a profit. The rest of them lost money. So why such the failure? Well, that's the answer. All of TV is covered with reality TV fix and flips. When I put this slide presentation together, I counted 47 different shows specifically on fix and flips. Now, obviously, being in the business, I do watch a little bit of the reality TV just for for the fun of sake of it. Absolutely nothing in any of those shows would I ever apply into our business. First of all, you never get emotional about your investments. That's when you start losing money. All these shows are about doing little trinkets and do this here and make this look like this and put that fountain there. No, we use the same color paints in all our houses. We use the same fixtures. We use the same everything everywhere. And it's never about emotions. So that's essentially why all these people lost money, is they wanted to be the next reality TV star and wanted to follow their guidelines of the masters of the flip. And there's just absolutely, when I look at the margins at the end of those shows, we couldn't live off of that. We certainly couldn't survive off of some of these profits they make, and we certainly aren't going to acquire the properties and the methods that they do. So that's essentially why the number of 13% is so low, and I'm surprised it's not lower. So let's look at some of our fix and flips, and you can access these from our website. Every month we put example of the month. It may not be the best one we did that month, but it shows the consistency of what we're doing. This one was a townhouse. It was a very nice townhouse. Net annualized return on it was 62%. The cash on cash was 22%. Those are the kind of numbers that we're able to make profits and stay in business with, not the 7% that you're getting on reality TV shows. And again, we're just in, no emotions, get the work done, get the paint on the walls, and be out of it. So the total investment on this was $505,408.84, with a net profit of $138,412.22. Something else you'll get on our website is we will actually break down all, so you can see exactly when we bought it, when we sold it. This one we bought just shy of a year ago. The listing and resale, we listed a little too low. The profits were still great, but you can see we listed it on June 11th and we sold it on June 14th in 3 days. But again, everything's the same color paint, same trim, modern fixtures. That's it. Nothing special, no additions or anything like that. Just get in, get out. And so you can see where PIP made its money was in the performance of the investment itself. And that's essentially how we work. So this is what fix and flips look like. This is essentially what you can look on our website and see, again, the numbers that we're looking for. If we want to be in the 20s, we want to be cash on cash in the 15, 16, 17. We want those net annualized to be up there. But if you go into our website and you click on read the full story, you can get all the details of when we bought it, what we bought it for, when we sold it, commissions, et cetera, et cetera. Now, when you go through our passive profits example of the month, if you're on our website going through this stuff, you'll notice most of our homes that we are middle income, run-of-the-mill properties, nothing fancy, nothing over the top. The townhouse I showed you is a bit on the extreme for what we do, but again, it just shows that even with the nicest properties out there, we're still not going in and putting in new and thicker granite and Bosch appliances and that sort of thing. Everything we do is going to be pretty much run-of-the-mill, middle-income family. And there's a reason why we do that. And the reason why we do that, as I mentioned it earlier, we do what's called recession-proof investing. So we're investing in areas that are off the radar buyers that have an economic push that would likely not be impacted by another financial crisis. So example of off the radar would be Raleigh at this point, and now also Long Island, because Amazon has made their decision that those are the two markets they're going to be in. So institutional buyers are going to be scooping up everything they possibly can in those markets. You're not going to be able to buy right, and I said earlier, you have to buy right. So in those markets we're buying right in right now are Augusta, Georgia, Savannah, Georgia. Reason we're in those markets is Savannah has a big push of ports. They're expanding their ports to be one of the world largest in the U.S. The reason we're in Augusta is they are moving all of the cyber command to Augusta. So the area is literally growing faster in middle income properties than we can buy. And we're essentially going off the model that Charleston, South Carolina was 20 years ago. You could invest so well in that market 20 years ago, and as MUSC built up and as Boeing moved in, that market became a very hard, very competitive market to buy in. We're essentially doing the same thing. So once Augusta and Savannah are built up, we'll move to another market. Okay, so a lot of you now are going, okay, Charles, there's no such thing as recession-proof investing. How about recession mitigation investing? So everything we buy is going to be what recovers first, just like we saw with the last financial crisis. So we're buying homes that easily qualify to first-time buyers, and we're investing areas where there's a lot of military and government lending programs. There's a slew of them in both Savannah and Augusta, which is where we're heavily investing right now. We also stopped lending last recession. We're also buying homes that typically don't require upgraded finishes like granite tile, but also that would cash flow well if lenders stop lending. So if you end up being a fix and flip person, all of a sudden the market falls out from underneath this, they're still going to cash flow. So you're still going to have, you know, a good cap rate well above average of what's advertised out there, or even the national average that's out there. So if the banks stop lending, you're still going to do very well in a cash flow play. It might not be the play you want to be in, but again, just like there's tax lien buyers and people who buy tax deeds because they want the property, same goes for cash flow investors versus fix and flip investors. Having the resources and being embedded in the industry like we are, we offer our investors a heck of a lot more options and opportunities to provide more protective measures, if you will, in your investments, regardless of what the market may be. All right, guys, we're coming into the home stretch here. So why the PIP Group? Well, the first one is we are now offering the Guru Rescue. There are so many investors out there that bought the coaching programs and the platform pitch programs and the weekend workshop that turned out to be no workshop at all, that we're offering a Guru Rescue option. It's a model that essentially we will not charge you anything in upfront fees. It is entirely based on the performance of your investment as to how you make your money. So we're employing that model now. If you are part of a guru situation, we will help rescue you and help you recoup some of those costs. With that, performance-driven investing. That's essentially what we do. That's how our model was built to begin with. Again, we do, in some of our opportunities, we do charge an upfront fee to get started. That covers our administrative costs. But for the most part, it's all performance-driven. If we don't make you good money on good profits on your investments, then we don't make any money. So we're there for you to keep the costs of fix and flips down, because the more you make, the more we make. Thing we introduced back all the way back in 2018, just last year, was a 16% promise. It's not a guarantee, and it only applies to our fix and flips. But we're so confident that we can get you an annualized net profit of 16% that, you know, as long as Mother Nature doesn't slow us down, or there's other unforeseen circumstances that delay the liquidity of the investment, you're going to get 16%, bottom line. So that's why we call it a promise, not a guarantee. And again, it only applies to our fix and flips. We're industry recognized, and we've earned a lot of rewards over the years, and that's obviously very important for investors to know that we are legitimate and we are being recognized by not just our peers but also our competitors. We are an accredited business. I will be the first to tell you that if you had asked me 6 years ago to become a BBB accredited business, I'd say no way. That's a pay-to-play platform. The way you get your A plus rating is paying for your A plus rating. Boy, did I have a lot to learn once we got our accreditation, how much they dig into the company. It might as well be an IRS audit. So why to you? Because less than 10% of private businesses in the U.S. qualify for a BBB accreditation. Tons of research is performed. Like I said, it's just like an audit. And approval is actually required by a board of directors rather than a simple application. So, I mean, it's a pretty decent process that you have to go through there. And the reason that we actually went out and got it was, you know, the internet is full of trolls with little to no regulation. I can go post some nasty things on, you know, what somebody might consider a competitor website, and it's there for life. So a longstanding Big Brother has become the only method of separating fact from fiction. So that's why being BBB accredited these days is important. And again, we are recent. All the examples I've shown you here today are within the last 6 months of recording this webinar. We're transparent. We have our own software platform where you can log in and you can see everything. We provide the addresses. We provide you real appraisals, real assessed valuations, and we're industry recognized. Again, we've won a lot of rewards. We've been on covers of magazines. I've spoken at numerous panels. I've been moderators for numerous panels. So we are recognized as an authority within our space. All right, now to the final. Did we buy right? So this house was a big mess, and for it, our winning bid on this property was $2,025,000, and buyer's fees we had to pay. The appraisal of the property came out to be on there, but I've raised it a bit for you, as is value of $2,300,000. So without touching it, we could probably do pretty well, but we decided to touch it, as you can see. The repaired value on it is going to be $3.8 million. As I speak today, we are about 90% of the way through the repairs, and we will be listing it for $3.8 and we hope to sell it for a net of about 3.6, giving us a profit of 1.2 or a 51.5% profit margin, cash on cash on this particular property. So yeah, we bought right. Even with the termite damage we found, even with the rot we found, you know, we could have spent twice as much in repairs and still made a huge profit on this property. But that's essentially the story of buying right. If we had spent, you know, let's say $2.8 million on that property, it still will have probably been worth $2.8 million. It's beachfront on a really nice high demanded island, but nonetheless, our market a little scary. We would have been sweating a little bit. If we decide to rent it, which we're not, the cash flow on it would be 11.5% net. So, you know, this one is one that rents for about $16,000 a week. But the cash flow is still well above national averages. So, you know, market falls out tomorrow, we can't get a buyer for this or an investor for this. It cash flows and still makes us a good bit of money. It's on Hilton Head Island, which we have been named the best island in the U.S. for the 3rd straight year. So we're pretty proud of that, and I wish that was the view I had from my house, but this is the view from that property. Great view, obviously, and so in closing, PIP is not a huge business. We are a substantial business. Fix and flips, we do about $25 million a year. Fix and flow, we do about $5 million a year. So fix and flow is going to be the tax deed, the secondary market tax deeds, or the pre-deeds. Those are always going to need a little repair. And then liens, we're only doing about $12 million a year. So we're not over the top, industry, corporate. You're going to speak to myself or one of 4 different people in our office when you call and have inquiries. So you're a name, not a number with PIP. So between $50 million and $60 million under management every year. How we come up with that number is obviously in tax liens. You've always got some coming in, some going out. So in the state of Illinois, it's a 3-year process. So that makes up about $30 million in itself right there. So between 50 and 60 million under management at any given time. So again, you're a name, not a number with the PIP Group. And again, just to remind you, performance-driven investing. That's what we're all about. We're not here to sell you a coaching program. I will never sell a coaching program because I believe this investing in distressed real estate is done by experience, not by coaching. All right, in closing, give us a call. Something else that's very important to us, as it is to you, is I always say, the more knowledgeable the investor, the more profitable the investor. And by that, I mean, you may have just watched this presentation and said, oh, wow, pre-deeds looks like something I definitely want to be in. And you may give us a call, and we're going to talk to you for close to an hour. By the end of that conversation, you may be interested in pre-deeds, or you may be interested in putting a little money in pre-deeds and a little money in fix and flips or in tax liens. But the important thing is that we want to talk to you first. We want to, essentially understand your exit strategies. So again, it goes back to being a name, not a number. Every investor is different. And before you become an investor, we want to understand what it is you want to achieve through your investment. So call us when you're ready. We'll talk about it. There's never, a pressure pitch or anything like that. We're just going to talk. If it's something you're interested, great. If not, good luck in your ventures. Thanks for the time, folks. 46 minutes and 30 seconds. I got this in under an hour, which I didn't think was possible. But, again, thank you. And that is essentially what PIP is and what we do.